There is now a clear divide between the haves and the have-nots in the hyperscaler space. Companies able to produce real revenue from their AI build-out are now being rewarded, whilst those with less than perfect explanations of what's actually directly affecting their revenue and bottom line are being punished. This has never been more true than recently when these major hyperscalers have reported earnings, and this will have a major long-term effect on the whole AI build-out and the bottleneck stocks altogether. So let's just begin, shall we? So Amazon reported fantastic earnings yesterday, and they were absolutely astonishing, let me just tell you that much. Amazon shares jump as cloud sales and spending accelerates. Company raises capital spending forecast to $220 billion and says AWS sales increased by 37% in the second quarter. That's a very big deal. The article goes on to say that the company reported higher than expected revenue from Amazon Web Services on Thursday, continuing a streak of growth for its cloud computing business, and raises capital expenditure forecast for the year to $220 billion, a $20 billion increase. As we all expected, another hyperscaler increasing their capex for the 2026 year. No surprise, we were expecting this. Everyone was raising money over the last couple of months. We could see that memory prices were going through the roof. There's also other effects of increased prices in the construction space, the labor space. This was to be expected. Andy Jassy, the CEO of Amazon, actually said some really interesting and insightful things in the earnings call, which are highlighted in these articles, which we're going to now go through, because they have really serious implications on what's going to happen in the future when it comes to the AI build out and memory stocks and everything adjacent to it. We've long believed AWS could become a few $100 billion revenue business, and now believe it will be at least double that, and very possibly a $1 trillion annual revenue business for us in time. Sales by AWS, a major profit driver, grew 37% year over year to $42.2 billion for the quarter, its fastest growth rate in 18 quarters. Amazon's revenue grew 20% to $200.6 billion, and net income was $62.6 billion. Both were ahead of analyst estimates. That is phenomenal. These results, to be fair, somewhat expected because we expected margins to increase, are crazy. We're seeing this across the board in software. Margins are through the roof. However, the company reported negative free cash flow of $7.6 billion. It forecasts revenue for the third quarter of between $197 and $202 billion, and operating profit between $22 and $26 billion. And if we look at this capital expenditure chart, it shows everything we need to know about capital expenditure from the hyperscalers. Amazon, in the very light blue at the bottom, is growing, and it's growing by a lot. And so is Meta, to be fair. But it doesn't end there. Amazon CEO Andy Jassy said demand remains so strong that the company still lacked enough computing capacity to serve customers, despite raising its capital spending forecast by 10% to $220 billion. That's incredible. Andy Jassy, talking about capex spending and memory prices, he says, even at that amount, we still don't have enough capacity to meet all of the demand we have in 2026. I believe this dynamic will also be true in 2027. AWS contract backlogs at the end of the quarter stood at $496 billion, up from $364 billion in the prior 3-month period. And finally, the other interesting point of the whole transcript was this. Jassy sought to explain the company's massive capital outlay on the call. Amazon starts spending on data centers roughly 2 years before they open, which creates a period where cash flow is flowing out but revenue has not yet arrived. Once operational, however, those facilities can generate revenue for 30 years, while AI servers typically recoup their cost in less than 3 years and then continue generating profits for another 2 to 3 years. And as we can see, capex is rising, and Amazon are not afraid to do that. Now, I love this call and I love everything we found out about Amazon because it solidifies everything I've been saying on this channel for well over a month. Oh, and before we continue, if you're enjoying this video, please give the video a like and subscribe. And if you're able to, also click the hype button. That does a lot to push the videos forward to a new audience, which means then we can get our message out. Anyway, let's get back to the video. And those things are quite simple. The real winners were always going to be, especially from the AI build out, the hyperscalers who do not care much about having a frontier model. The whole area of having a frontier model is a fool's errand, in my opinion, simply because a lot of the time they'll spend all the money trying to build something unique only for their competitors to be able to catch up. We've seen that in ChatGPT, we've seen it for Claude, and I believe in the long run having a frontier model will not necessarily be the best play in this space. Amazon, on the other hand, who just want to be able to provide the infrastructure to run AI models alongside companies' data and their own software platforms, well, oh my god, they're the real winners. Which means then that they don't have to spend all that money on frontier models. They just need to make sure that they've got all the hardware and all the build out and all the data centers they need to be able to look after the demand. Which is interesting because, as Jassy even said himself, they don't have enough capacity to look after the demand that they have at the moment, and all future demand in 27 and 28 has already been accounted for. The other thing I've always said was that guidance would keep going up, and I've been pretty bullish on this simply because it was obvious that over the last couple of months, these companies were raising more and more money. We knew that memory prices were going through the roof. They didn't seem to be slowing down in Q1 and Q2. They're even nudging up in Q3, which means that the only people paying for that are the companies like Facebook, like Google, and like Amazon. And this is all good news for memory stocks because they're the ones that benefit. Demand for artificial intelligence is off the charts. And the other thing that I think about a lot, and I've said on this channel quite a few times now, is that you need to consider what the bears and the haters are saying, and we need to reframe their argument just so we understand it better. One of the key points that the bears come out with is that they're complaining about the profitability of frontier models. If they're saying that, then yes, there might be some legitimate worry there. Are they going to have a suitable competitive advantage that allows them to earn a margin suitable for the amount of money they spent in? I'm not necessarily sure. The other argument is that AI as a whole is not going to produce revenue and there's not that much demand for it. Amazon has proven that that is simply not the case. There's an enormous amount of demand for intelligence across the entire world, from private enterprises to just individual use cases. I think fortunately enough for a lot of my subscribers here, most of us are not invested in any way, shape or form in the frontier models like Anthropic and ChatGPT. We may have some exposure through like a Google and Amazon who's trying to do some stuff here and there, but ultimately it's not really what we should be worried about. It was also extremely bullish that Jassy tried clarifying how these cost structures work. And the fact is that they can spend loads of money building out a data center, and that will sit there for 30 years and can be used throughout the 30-year lifespan. However, the network equipment like the chips, the GPUs, CPUs, the memory may only last for about 6 years, and it takes about 3 years to recoup the costs and another 3 years to earn money off of it. What that might tell us, as you know, people invested in maybe the memory stocks and also AMD and even Nvidia, is that the cycle of these things is going to keep going. And those arguing that memory, for instance, is cyclical may be proven wrong here, but that's still up for debate. And when we just look at Amazon and their future projections and how I believe that Amazon are probably going to be one of the biggest beneficiaries of the AI deployment era that we're in, is that they actually now control data centers and power, the networking, its own Trainium AI accelerators, its own CPUs, it has a model marketplace through Bedrock, and it has the enterprise software and agent layer through products such as Q, Cairo, and Connect. It's literally set up to benefit enormously from the build out. No wonder why the stock raised by about 13%. Just look at the results there. It is absolutely fantastic. And I do believe that Amazon still is probably underpriced in the long run. They'll be an enormous beneficiary of the whole build out. You can see it already, and it's going to continue. I love these results. I think these results are absolutely fantastic because once again, it just gives more evidence that there's a real business there in AI. All the people for months now, including some really popular bears and haters who are saying that there's no demand in the AI space and it's a terrible business model. It will never generate any ad revenue or anything, or it will never generate any revenue because it's principally just the worst thing ever, are being proven wrong. There's an enormous amount of demand here, and that demand will, over time, be met with spare capacity and capacity in general. That is good. It means that as we go into 27 and 28, more and more people are going to use AI, more businesses are going to integrate it further in their companies, and that means more memory, more CPUs, more GPUs will be needed to be bought. And the reason I'm so keen to be optimistic about this is that, ignoring Amazon for a second, if you look at a company like Google or even Meta, they see this as an existential threat. Can you imagine now Googling something, if you even do anymore, but Googling something and not getting the AI result at the top? If you didn't have that and you had to actually go through each article on your own, read loads of useless information because it's trying to search higher in the Google searches by having more and more keywords, and then just to try and find the information you want. That is a terrible business model, especially when you can just go on ChatGPT seamlessly, ask the question and get the answer you want. All of these companies in time are having to respond to the threat of AI by incorporating it themselves. And it won't just be the likes of Google and Meta, it will be everywhere you can see it. And I'm talking insurance companies, banks, marketing, you name it. It will be everywhere, which means enormous demand to come that's not even been really acknowledged yet. Thank you for watching. As I always try and say, if you want to support the channel, there's some links in the description. Also, a like and a subscribe help. A hype is even better. That really pushes the videos out. I'm trying to cover more than just memory stocks now. I'm trying to cover the whole AI industry, including how it's affecting macroeconomics, CPUs, GPU companies, just social concerns too. I think there's so much more here we need to talk about. So anyway, thank you for watching, and I'll see you in the next video. Bye for now.